Thank you. Well, thanks for inviting me to come along today and talk to you all about exit strategy, particularly focusing on practice salability and value. The aims for today is to help you understand the current buy-sell market dynamics, give you a bit of an idea of who is out there buying practices, particularly physio practices, and what it is that they're looking for. I'm hoping to help give you a bit of an understanding about what makes a practice more or less saleable, and to identify some of the factors that will influence valuation. I'll probably be talking at you for around 30 minutes today, so that'll give you plenty of opportunity to ask questions at the end. I'll sort of try and throw in a few examples and keep it as not too dry, but it is elements of it are a fairly dry topic, so it always comes to life if you've got some questions and examples, etc. at the end. Just a very brief introduction for those that don't know myself, my background, although I recognise a few names of people that are on the call, and you probably do know who I am. But I started my career as a physio. I founded a private practice in Hertfordshire in 2012, and I expanded that to around 36 clinics over a period of 7 years. Part of my journey was buying practices, so I bought 7 businesses ranging from 100,000 turnover to around 1 million turnover, and consolidated them into a single company, single brand. And I believe at the time we were perhaps not the largest physio group, but certainly in the sort of top 10, top 20 in the UK. So I've got a reasonable amount of experience in operating physio clinics and have a good understanding of the business model. I have a lot of experience in buying businesses. I have experience in selling, refinancing, working with private equity, etc. So hopefully that is what sort of qualifies me to talk about this topic. That business venture culminated in a partial exit to private equity in 2009, just before the pandemic. I continued to run the business throughout the pandemic, and then almost fully exited post-pandemic around 2021, which is when I founded Verilo. Verilo is an M&A consultancy. We are sector specialist business brokers, and we focus primarily, well, exclusively on the health, medical and wellness sector. The vast majority of the businesses that we've worked with to date have been in musculoskeletal health, so physio, osteo, chiro. That being said, we've also worked with psychology practices, psychiatry, cosmetic medicine, aesthetics, hair loss practices. So there is a little bit more variety to it. I founded Verilo with some very clear principles. I've had a lot of experience working with business brokers over the years, and one of the key things that I wanted to make sure that we did right was expectation management, which I'll touch on a little bit more in the next slide. I believe good expectation management with both sellers and buyers is what leads to a good and high deal success rate. In the last 2 years, we've worked with around 50 private practices, and we have an 85% success rate of businesses being sold or under offer within 12 months. So just to start things off, I'm going to talk you through a little bit about what's happening in the marketplace at the moment. As I said, I'm big on expectation management, so I'm going to start with a few negatives and reality checks, but I think it's very important to highlight some of these. So unfortunately, selling a practice is not guaranteed. It's not easy, although with my incessant LinkedIn posting of we've completed a sale or we've got another deal, it makes it look quite easy. I can assure you that there's a lot of hard work and challenges that go on in the background. So yeah, I just want to be clear, it is not easy to sell a practice. The reality is that some won't sell, so there is no guaranteed exit, but with the right set of factors and the right support, they can. A lot of, sorry, before I move on, there is a statistic that sort of is floating around that suggests that around 50% of SMEs are still listed as for sale 12 months after their first put on the market. Now, do bear in mind that that includes practices or businesses that perhaps aren't suitable for sale. It includes those who have perhaps gone with the wrong broker or attempted a DIY sale when they perhaps shouldn't have done. So it's not necessarily representative of your chance of sale, but it does highlight what's happening in the marketplace. A lot of practice owners or business owners have misconceptions about the time it takes to sell a business. Most people think that it's going to be a case of putting it on the market, finding a buyer within a few weeks or months, and then a deal is done. The average time frame to sell a practice is around 9 to 12 months. That's broken down in several phases. So the first phase is finding a buyer, and typically that's around 3 to 6 months. So I would normally anticipate finding a buyer and getting an offer within that period for most practices that we take on. The surprise quite often comes to people is the next phase, which is due diligence and legals. Most people think that once you've been given an offer and you've accepted that offer, that it's a case of sign on the dotted line, deal done, walk off into the sunset. Unfortunately, that's not the case. There's a period known as due diligence, which typically takes 3 months, although in many cases can take 4, 5, 6 months. And alongside that, you have solicitors working with you to prepare the sales documents. So that's why it takes, as I said, 9 to 12 months, and that's all being well. The other thing that I often see in the marketplace is misvaluation of practices. So again, valuing a clinic or valuing goodwill is not an exact science. There is a fairly commonly accepted methodology, which is based on a multiple of adjusted net profit, which I won't go into too much detail around today, but ultimately a business is worth what someone is willing to pay for it. It might seem a slightly odd thing for me to say, but I tell this to all clients, and I don't actually like referring to myself as a broker for this reason, but do beware brokers. The industry as a whole is pretty poorly regulated, and therefore anybody, regardless of experience, can claim to be a business broker. And as with any industry, there are good and bad practices to look out for. The one thing I will highlight is if you're exploring the sale of your practice and you're going out and speaking to brokers, don't choose the person that is telling you what you want to hear. There's a lot of practice owners that I speak to that when they have a conversation with me, they say, so and so broker said my business was worth more and it was highly likely to sell. That is a fairly common tactic that people will use to try and get you to sign up and charge a very high upfront fee. I will always be very candid with people because I don't want to waste their time or their money or my time. So just something to look out for. Don't go with the person that tells you your business is amazing and highly likely to sell and sell at a high value. Go with somebody that you think is going to do the best job, is being honest with you, and has the best network and the best chances of actually selling your practice. The other thing I see is people leaving it too late. So I can't stress enough the importance of planning a business sale in advance if you've got the luxury to do so. Most business owners fail to plan their exit, get to a point where they're ready to leave, or something happens in their business triggering them to leave, or health want to leave, or a health issue, or they get to retirement. But if you haven't planned it, planned your exit in advance, this can have an impact on your chance of sale and value. The good news is that you can influence your saleability and value. The healthcare market as a whole is a very attractive sector for investment. Buyers are spending, which I think most people might find surprising given the rocky state of the economy over the last few years, and also looming political change. Although I do recognise that inflation seems to be getting a little more under control, which is positive. But yeah, certainly buyers are spending. And it's important to note that the right businesses are selling, and those that don't are usually due to mismanaged expectations. So a seller thinking that they're going to achieve a certain purchase price when in fact the business was never likely to sell for that. Another common question we get asked is who's actually out there buying physio practices, osteo practices, and the likes. So I've tried to I created this table to break it down into groups to give you an idea of what sort of buyers are out there and what they're targeting. So for those of you that are more owner operators, and by owner operators I mean you have you're responsible for perhaps 80% or more, or 100% of the income of your practices, and perhaps sort of have a smaller single room practice. Mostly you're going to be attracting local trade buyers and associates, and this generally forms the smaller proportion of the market, so around 5 to 6% in total. Those of you that have got practices that are 500,000 to 1 million or 1 million plus turnover with large teams, these are considered larger practices or platform businesses, and you're going to appeal to private equity or large sort of national trade buyers. The vast majority of businesses that we work with fall into this mid-sized practice region. So anything above 200,000 up to about 500,000, although we work with plenty that are 500 plus, 1 million plus, and several sort of over 2 million. But most of the practices that we see and work with fall in this midsection. And the types of buyers that are out there for that are you have your regional trade buyers. So that might be physio osteo groups that have 5 or 6 locations within a particular region. You have buyers from outside the sector. So this often surprises people, but there are quite a few buyers that have perhaps operated in a completely different sector. And as I mentioned in the previous slide, healthcare is an attractive investment opportunity, and they're looking to diversify their portfolio and get into healthcare. So we're finding more and more people from outside the sector looking to buy this sort of business. Individual investors or groups of investors known as consortiums, they make up quite a large proportion of our network. You have market consolidators, which is a small group of individuals or companies that have got a fairly predefined valuation and sort of offer proposition, and they're basically looking to go out and buy up multiple practices, consolidate them, and then sell them on in the future. So that's roughly what the market looks like. But I find most people think that the immediate buyer is going to be an associate, whereas actually that's the smallest proportion. We have sold a few to associates, but it's not the immediate go-to. So what factors influence saleability and value? The first one, and probably the most important or the biggest driver of saleability and value, is your financials. So again, I've created a bit of a table here to give you an idea of how the revenue impacts saleability and valuation. On the left-hand side, we have revenue. So the top left-hand corner, you've got practices that are turning over less than 75,000. So that's probably your typical owner-operator or sole trader. All the way up to 1 million plus, which is probably the higher end of what we see in this particular market. You'll note the first three, so up to around 200,000. The chance of saleability increases, but fairly incrementally. There's a big jump up in saleability around the 200 to 250,000 pound turnover mark, and the reason being is most buyers will start to consider that as a slightly less risky business, because you've probably got more infrastructure, revenue is split between multiple practitioners rather than yourself. So there's a larger pool of buyers targeting businesses that are 200,000 turnover and above. The valuation also changes as turnover goes up. So generally, sole trader practices or very small businesses, you're looking at a sort of 1 to 2 times pre-tax adjusted profit valuation. Whereas when you're looking at $1 million plus, you're looking at much closer to sort of 4.5 to 6 times exit value. What I'm seeing in the market at the moment is generally, certainly businesses that are business sales that are being brokered through myself, we're seeing valuations at the higher end of these. But yeah, this just gives you an indication of how revenue impacts value. So what I would say is if you're in the under 200,000 bracket and you are considering your exit in the next 5 years, it's probably worth looking to make some changes in your business now in order to get above that 200,000 sweet spot. This isn't an exact science, but it certainly gives you an indication of how revenue impacts saleability and value. This should also be taken into context with other factors, which we'll discuss later. So just because you have £1 million plus business, if all of that revenue is being done by 2 or 3 people, or there are some other factors that make the business less desirable, you won't necessarily hit the valuations suggested here, nor the saleability. So that is just one factor. Moving on, the number one reason that I see businesses fail to sell is because there's too much reliance on the owner. Particularly when that owner is generating all of the all or most of the income revenue for the practice. Where possible, and again, particularly if you have time and you're planning your exit over a number of years, try and reduce your revenue as a business owner to under 20%, and also try and minimize the reliance on you as a business owner for the day-to-day running. You should always be thinking about, can the business run without you? And if the answer is no, then it may well be that you've got a job or that you've got a less saleable business. So do what you can to make that shift before sale. That's not to say that if you are responsible for quite a high proportion of the revenue or the day-to-day running, that your business won't sell. It just makes it harder. It will have an impact on the purchase price as it's a more risky.
On middle way?
Oh, sorry, say again.
Yeah, it's on Google Maps and it's on our web.
Right, not sure what happened there. Yeah, the impact of the owner's role on the structure is this. So yeah, the purchase price will be reduced if there's too much reliance on the owner. You will also find that you might have to agree to alternate deal structures. So if as a business owner you are responsible for a high proportion of the revenue, you may find that buyers will put more emphasis on an earnout, which is usually something you want to avoid. You will also find that handover periods required are significantly longer if you're the main income generator. Like with yourself as an owner, the same thing goes for your team, where if you're in the position where you can put an admin and management team in place, that's fantastic, and try and make your business more process driven. With your clinical team, although most of us have had superstar physios or osteos that are high revenue generators or have got a very specialist skill set, that's when it comes to selling, if you've got one superstar practitioner and all of the revenue or a high proportion of the revenue is linked to them, that is seen as a risk factor for buyers, and therefore you want to try and diversify your team and spread the revenue or the client base amongst them. So when it comes to staffing and your team structure, always be thinking about how you can reduce the risk for a potential buyer and ensure continuity for the business. The premises are also very important. Geography and location has a big influence on saleability. Now, I'm not expecting anyone to upend their clinic and move it from one location to another, but I think it's probably useful to give you an indication of how geography does impact saleability. So, for example, if I were to launch a business doing 300,000 to 400,000 turnover in central London and put that on the market for sale in this sector, we're typically seeing between 30 and 35 expressions of interest on a business of that size in London in the first 24 hours of launch. If I were to launch the same business in Manchester, it might be closer to 20 to 25. The same business in the Northeast, 15 to 20. And if I were to pick a rural area in Scotland or Wales or perhaps the Isle of Wight, where the pool of buyers tends to be a little smaller, I would be expecting more like 8 to 12 expressions of interest. So it just gives you an idea about how geography influences saleability. The biggest thing that you can hopefully influence, although perhaps not if you're midway through your lease, is security of tenure. So it's never a good idea to sell a business when you've got six months left on the lease. Buyers will want to see a longer period remaining so they can get a return on their investment. So if you can renew or extend your lease, or at least have a verbal or other evidence of agreement from your landlord that they're willing to extend the lease, this will improve your chance of saleability and potentially the value that you can get, and also the deal structure. For context, if you've only got a year left on your lease, it's unlikely that you can expect a buyer to be paying you a 3 times multiple of net profit, because quite simply they won't have, they won't be able to get that return. They need to be pretty comfortable and confident with that they can renew that lease or relocate your business quite quickly. Things that you can influence or certainly consider when setting up new locations. You don't need to be in a primary high street location necessarily, but certainly buyers have a preference for well-populated areas with a good level of passing trade, whether that be pedestrian or traffic. Ideally, a visible frontage. And buyers like to have prefer practices with multiple rooms, as this means that they can diversify the use and potentially it means that there's some room to grow. Don't worry too much if your business is only operating at 50 or 60% capacity. While buyers won't pay for potential, they're certainly open to the, if you've got capacity to grow, this isn't necessarily a bad thing. A lot of buyers like the idea that they can buy a practice for what it's worth today, but have the ability to expand revenue streams and build on what you've built. So it's not a bad thing having some capacity. If you can avoid home clinics, they are fantastic from a lifestyle point of view. Very good income generators. They keep your overheads low. Unfortunately, home clinics are particularly unsaleable. If you do have a home clinic and you're considering an exit, you might want to think about whether there's the option to relocate that business into other premises. However, you do need to do a bit of a cost benefit analysis on the cost of relocating that, the impact to your revenue going forwards, and the likely sale price. But I'm always happy to chat through those options with you. And then finally, having a diverse client mix and contract stability is important. If your business is over reliant on a small number of contracts, like the NHS or occupational health, even though these contracts are generally considered quite desirable by buyers, if a large proportion of your income is associated with a single contract or a single client, this will put buyers off. In an ideal world, try and aim for less than 10% of revenue contribution per client group. And where you do have contracts in place, make sure you've got proper documentation and that you've got as long a period as possible remaining with that. If you can't get a renewal, try and have conversations with that client prior to selling and get evidence that that is likely to be renewed. These kind of things will all help with your chance of sale. Be aware that obviously contract terms will impact the multiple paid and the deal structure. Much like security of tenure, if you've got if 50% of your client base is with a single NHS contract, and that NHS contract has only got a year to run, it's probably not reasonable to be expecting a 3 to 4 times multiple on that business, quite simply because there's no guarantee of renewal. So just a quick recap of the key value drivers and salability drivers. Grow your revenue, try and reduce owner involvement where you can, build a reliable team, but try not to become too over-reliant on any one individual. Make sure that you have security of tenure in place, ideally a 10 or 15-year lease with 5-year tenant-only breaks. Try not to become over-reliant on a single client group and make sure that you can evidence any contracts that you've got. Hopefully that has been useful for everybody, and I am more than happy to take some questions now. And if anyone would like to book in for a call with me, you can go on my website and book a session. I don't charge. I'm quite happy to speak with anybody, whether you're a one-man band or you've got a 5 million turnover company. If I can be of assistance to give some advice, I am more than happy to.
Brilliant, thanks, Josh.
No problem.
Very insightful indeed. Just a question from me in terms of, given your experience in seeing a number of different businesses and obviously understanding what buyers are looking for, are there one or two or three things that tend to stick out consistently in terms of feedback to anyone selling a business that they should do in advance to prepare, particularly presentationally, how to present the financials to a buyer? I'm thinking things like accurate presentation of gross margin or understanding the cost of sales. Is there anything like that that really is consistent that people should be thinking about?
Yeah, I think so first of all, I mean, particularly with smaller businesses, what you tend to find is that the business owners will obviously try and be as tax efficient as possible. So it might be that as a business owner, you are paying yourself a minimal salary and doing all of the work and paying yourself dividends. That's not a problem, but obviously what you need to be able to demonstrate is that's not necessarily your true profitability. So working with your accountant to look at what the replacement cost might be, or with someone like myself to apply that is important. In terms of, I think your point, Simon, around cost of sale, I do quite often see sets of accounts where their cost of sale isn't accurately reflected, and that is a bit of a bugbear for buyers. Quite often, if you've got salaried physios, they're just put in the payroll column under expenses. And of course, it's then very hard to see how your cost of sale is fluctuating, or whether it's a market norm or not. So if you can work with your accountant to make sure that items such as the cost of physios in your business are put in cost of sale, then it makes buyers' life a lot easier. I can certainly help to extrapolate those numbers and put them into tables, but the less work a buyer has to do to find out to determine the value of your business, the better.
Brilliant, thank you.
Right. Any other questions?
Thanks, Joshua. I'm just curious to know a bit more about security of tenure, so in premises. So do some buyers not worry about committing to their massive liability of a 10 or 15-year lease? Imagine a business in central London that's got a massive rental on it. Is that not viewed as a liability as well?
I take the point. Yes, it certainly could be viewed as a liability, but I think if your contract, so if your business is profitable and it can sustain that lease, and it has done for many years, that is what they're looking to buy. So it's far better to have a longer term lease in place. That being said, if you've got a shorter lease and it happens to be inside the Landlord and Tenant Act, which means that you're much more likely to get it renewed, that is equally good. Even better, I think I sort of briefly touched on it, but perhaps skimmed it a bit quickly. If you can get tenant-only breaks during that period, it means that you've got the best of both worlds. You're providing security of tenure for a potential buyer, allowing them a maximal period to get a return on their purchase, but also should the market change, or should they decide that they want to downsize or locate elsewhere, they can do it within a couple of years rather than wait until the end of year 15.
Lucy, you have a question.
Yeah, I've got a very simple question about notes, Josh. Hi, Josh. Thanks for that. It was very insightful. What happens about, we've got a big pediatric neurology department, and we keep our notes for, I think most of it is MSK is 8 years, but a lot of it is 20 years. Is somebody happy to come in and take on that liability, or what would they do about that?
That's an interesting one. I think probably needs a little bit of additional guidance from someone like the CSP as to where those notes should be. But my view is that the client has been past the practice. Those notes continue and stay with the practice, if of course it's a share purchase. If you're doing an asset purchase, it's slightly different. Do I need to explain the difference between asset and share purchase?
Yeah, if you could, that'd be helpful.
Yeah, there's quite a key difference. So a share purchase, if you've got a limited company and a buyer comes in and buys that limited company from you, in theory, depending on how you've operated, all of the client base and the notes associated with it belong to that company, and therefore you are not transferring those notes or clients anywhere. You are simply selling the company on. So there is no real transition. You will still likely have your own professional responsibility to those clients and to kind of keep those notes, but the notes will transition across. There's a difference if you are going through what's known as an asset and goodwill sale. So this will apply to sole traders that don't have a limited company, or those individuals that have a limited company but for whatever reason choose to keep the limited company and sell the assets and the goodwill. If you're selling the assets and the goodwill, you are effectively those assets, which might include your client base, are transitioning from one entity, your limited company, to another entity, and therefore a transition takes place. So that opens up a bit of a minefield with GDPR, and also there may be some more considerations for who ultimately has responsibility for those notes. But I think that's probably, I think that part answers your question, but certainly I would be getting professional guidance on your responsibilities as a practitioner, as well as the company transition, if that makes sense.
Yes, thank you very much.
Hi, Josh. Thanks for that.
David?
I just wondered, you mentioned over-reliance on single contracts.
Yes.
Does that apply to private medical insurance companies as well?
Depends whether you're referring to private medical insurance or intermediaries. So if you're referring to private medical insurance, AXA and Bupa, I wouldn't be too concerned, because unless things have changed since I operated physio practices, the way those clients find you is directly. Most of the time, I appreciate that sometimes Bupa may refer, but I mean, it depends. If 90% of your business is associated with Bupa, and there's a risk in 2 years' time that your Bupa contract doesn't get renewed, that is a risk factor for buyers. But I suspect, if your practice, like many others, sort of follows normal industry trends, you might have 20-25% that are associated with Bupa, 20% with AXA, a chunk private, and hopefully a small proportion or none of intermediaries. If, however, you are very reliant on a single intermediary, say Nuffield, HCML, IPRS, and that makes up 50% of your business, that would be a big risk factor for a buyer, because they are referring directly. So that's the key difference.
Thanks.
Okay. Any other questions?
Joshua,
Stephen.
thanks. Really insightful, useful so far, so appreciate your time. Where do things like websites and some of these less tangible things and brand value, etc., tend to play a role? They don't actually. For most buyers, it is just simply a multiple of EBITDA, and other aspects don't play a particular role or influence.
So I think they do. So I've tried to focus on probably the 4 biggest factors that influence saleability and value. In terms of valuation, there's a common misconception that you can sort of break down your individual assets, like your website, your client database, etc., and that each one of them have I suppose, a more tangible value to them. The way I try and explain it is each of those individual items are on their own pretty worthless. If you just sold your website to a random person with nothing else, it has very little value. Those intangible assets combined, so whether it be brand, website, client base, etc., they do have a value, but that value is determined by the output rather than by the inputs. So the individual items themselves are quite hard to value, and also the investment that you put into those isn't necessarily what you're going to get back. The way that most buyers will value your business is take all of that together, and what is the output, and that is ultimately the revenue and profit that you're generating off the back of those intangible assets. That being said, if you've got I suppose there's a few ways to view it. If you've got high revenue and good profitability, and yet your brand is pretty poor and your website's a bit outdated, some buyers might view that and say, well, actually, despite all of these things not being that great, you are doing good revenue and good profit. So imagine what I could do if I came in and bought your practice and made some tweaks to these. So that might be the mindset of some buyers. Others may turn around and say, well, actually, I'm buying a turnkey solution. You've got a great website, a great great brand. I don't need to do anything, so it's nice and easy, and therefore they may place a bit more value on your business. But generally, those points are a bit more subjective. It's probably the equivalent of a sort of a 3-bed house is probably worth the same along the street, and if someone's got a new kitchen, well, if the buyer likes that kitchen, they might value it higher, but if they don't and they're going to rip it out again, then it has no value to them. So those intangible assets, as you might expect, are fairly subjective when it comes to value.
Thank you.
Any other questions? Looks like that's everything.
That's great. Great, Josh. Really appreciate your time and insight in sharing your experience with the members today. And I'm sure there'll be some that probably get in contact directly to have follow-up conversations. So really appreciate you taking the time to speak with us today.
It's fine. And if anyone wants to play around and get an idea of their what their practice might be worth or their chance of sale, it's not a perfect tool, but I do have a salability and valuation calculator on my website, free to use. Have a play around with it, and it will give you an idea. It doesn't take into account every every factor, so I wouldn't rely on it as a formal valuation, but it's certainly a useful tool to give you an idea. And also even the questions that are asked within those tools, again, should give you a bit of a hint as to what buyers are looking for. And as I mentioned at the end of my presentation, you are more than welcome to submit an inquiry through my website, book a call with me. I never charge for initial consultation, always happy to have a chat, regardless of the size of your practice or whether you think it's saleable or not. Always happy to have a chat, learn about your business and give you some advice.
Right. Thank you.
Thank you very much.
Thanks, everyone.
Thanks.
Thanks. Bye.
Thank you. Bye.
Thanks.
Thank you.
Thank you.
Hi, Josh. Did that go all right?
Yeah, I think so.
Yeah.
What happened in the middle? I think there was someone unmuted.
Oh,
and,
dear.
Anyway, a bit sidetracked, but never mind.
Okay. Well, as I say, if you want me to share any slides, just send them over and